Hi everyone. So today I'm going to be covering Howard Hughes Corporation. It's come into recent news because Bill Ackman, the famous hedge fund investor, has offered to acquire the company to run it as his own Berkshire. So I just want to go into it, see what he's thinking, go over some of the articles that he was talking about the acquisition. So let's get right into it. So first, it's going to be the investor presentation. I want to present to everyone to see how and what the company does to actually generate money, why he would be interested in such a company. And for those of you that may not know, it's a master plan community. It's in obviously real estate. And just to read off some of the bullet points here, they have a proven track record of developing the most sought after places to live in the nation. They're a self-funding business cycle using proceeds from land sales, condo sales, and NOI to fund new developments. They equip with a secure balance sheet, and it's true, they do actually have a good free cash flow system now, and we're going to get into that in a second of how that changed and everything, but very interesting. So these are their three ways that they generate money: master plan communities, so it's residential and commercial land sales, condo projects, and diversified real estate portfolio, mixed use environment. So that's probably commercial, residential, blended, maybe malls, things like that. Then you have this. It kind of speaks about their cycle of what at least their business model is, their business strategy, which is pretty interesting. So you have grow, live, work, play, learn, worship, and this is why their master plan communities are actually very successful in general, I'd say, and they're located in very good areas, metropolitan areas. They're suburbs of Houston, I believe Las Vegas as well. And a little interesting fact: this company has been around for a long time. It's called Howard Hughes Corporation because it was the land, or the original corporation called Suma Corporation, that was under direct control of Howard Hughes at one point, and that corporation owned a lot of acres of land at the time. I think it was in the 60s and 70s that started to become about. So when Howard Hughes was alive, that's why I believe they kept the namesake of it. Because he acquired so much acreage for the company. So anyway, they're talking about master plan communities, how they do things there, and then these are the places that they're situated in. Like I said, Houston, over 40,000 acres with a population of 140,000. Vegas, Phoenix, Maryland, and Hawaii. Obviously all prime locations, I would say, especially Phoenix, Houston, Vegas. They're really booming, so that's fantastic to see. Let's see what else. Let's see what else is going on. And this slide's important as well. So this is the master planning process. This is how they essentially have, I would say, a way of generating money without getting any kind of like outside investors or anything like that. So how it works is they have initial master planning, infrastructure development, land sales to home builders. So those land sales fund future vertical development. Then you have commercial land sale for churches and community services. That goes to develop neighborhood retail grocery stores. That goes to develop office building commercial centers. And then the rental cash flow funds future horizontal development. So that's how they generate that free cash flow forever. That's what they're saying. So I believe that's what Ackman sees in this, is that there's some level of float from the rental income, from the land sale income, probably from the condo sales in, I think it was Hawaii as well. So, that free cash flow, that float, Buffett has famously said he could use that to deploy it into different businesses, get into different management control. So, interesting theory, I think, overall. This just talks about more the outsized returns that they've had in commercial and residential. They have done very well in both. So it's good to see land appreciation as well, because they just own just so many acres of land. They own thousands of acres of land. And then this is another slide that talks about their continued free cash flow generation. So yeah, condo profit, operating assets. So this is the stuff that they were talking about earlier in the presentation of how they make money. So that generates a self-funded cycle. So operating asset NOI covers recurring debt service and G&A. Then creating free cash flow from condo sales, leading to financial flexibility in a self-funded development cycle, opportunity to achieve the best risk-adjusted returns on our investment. So very cool to see. I think it's very clever how they do things. I think a lot of real estate companies do mostly the same thing, like Pulte and Lennar and things like that. But Ackman is proposing, I think, a little bit of a twist on it too, because the company seems like it has made a decent comeback, even though the share price does not reflect that yet. But this just kind of goes into more detail about their debt, the mortgages, things like that. But I just wanted everyone understand what the company actually does. And yeah, these are the acres that they own. So super interesting. Next thing I want to show is their acquisition. So in January, Ackman, I believe, was trying to acquire the company for around $61 to $70 a share, and I think now he's raising it to $90. So let's read into the article a bit. So he proposed a $900 million deal to increase Howard Hughes' stake. So billionaire investor Bill Ackman, Pershing Square Capital Management, said on Tuesday it issued 10 newly issued shares of Howard Hughes for $900 million. Shares dipped, whatever. And where is it? Here it is. The proposal would take Pershing's stake in Howard Hughes to 48% from 37.6% it currently owns, and replaces a previous offer of $1 billion made in January that would have increased its stake to between 61 and 69%. Howard Hughes said in a statement late on Tuesday that its special committee would evaluate the revised offer and see if it's determined action. And the reason why I'm covering this company, besides Ackman being involved with it, I thought it was interesting because there's a bit of controversy here. He said he wanted to make it a mini Berkshire, but the problem is Buffett never charged a management fee or a performance fee for people just buying the stock. And if you see right here, I'm going to go back to the screen, but you see right here, I highlighted it, Howard Hughes to pay $1.5 million annual fee of its market cap to Pershing Square under a services agreement. So that's a management fee, essentially, per year. I mean, that's going to end up in millions of dollars, taking away from shareholders, and people were pretty pissed about that. If I'm being blunt, I saw it on X, I saw it on Twitter. So they really did not like that. They thought that was really going against what Buffett has taught about management fees and performance fees. So, yeah, I mean, I don't like that either, personally. If you're going to make a mini Berkshire, I think you should honor Buffett's legacy. You shouldn't have that kind of stuff, but, to each their own, I suppose. Anyway, Howard Hughes currently has a market cap of about $3.8 billion. Pershing said it would finance a deal for Howard Hughes, which owns and manages commercial residence, like I said, with cash on hand. And, he's been there for decades, since 2010. So, interesting little article to kind of explain it. Next thing I want to show is free cash flow, see what's going on. So they have made quite a turnaround, like I said. It's been a rocky couple of years, but overarchingly, it was negative $74 million in 2020, and now it's positive $158 million. So that's really good to see. But again, it's been up, it's been down, super up, down, bad, and then up again. So it's obviously a super cyclical industry based on generally interest rates. Supply, demand, those, geographical location as well. So you're going to see it here in a second with Simply Wall Street. It shows the same thing. Very cyclical free cash flow, and they don't even know, analysts, where this is cash. The pink is in free cash flow, so they don't even know where it's going to be. Right now, it's positive, could dip negative. It looks like it might be a little bit better, but it's very cyclical. Of course, it comes with the territory because it's real estate. Real estate is generally cyclical. But it's not like a compounder, not like a Google or something. That's a little bit more easier to predict, I would say. Financial health. Let me show you that. Yeah, I don't like the financial health. I mean, generally, of course, with real estate, you're going to get significant amounts of debt because of mortgages on the buildings, the development, the land, of course, and that's how they finance these things. So you're, of course, with real estate, you're always going to get a huge loads of debt, but the free cash flow is very small, or the cash to cash flow equivalence is very small. I mean, maybe if Ackman could raise this significantly, but it's yet to be seen. He's a very intelligent guy, of course, super successful. So I don't doubt that he could do that, but yeah. Interesting enough. Next thing I want to show is my DCF on this. My DCF is saying this is based off historical value. It's 16% overvalued. Interesting though, if you check Wall Street, I don't think I've ever seen this before. If you check Wall Street's actually saying it's undervalued by 45%. So Wall Street's more bullish than historicals, maybe because they're pricing in an Ackman acquisition. So that could give the stock price a little bit of a bump here. So very, very interesting. Next I want to show like the 1 year, because I think the 1 year is going to be imported. And use the store. Yeah, okay. Maybe the 1 year is not good to show because I don't think it's going to go $23 a share. But this is just standard 9 discount rate, 3% terminal growth at 67. So I'd go by the 5-year instead. I think it's a lot more realistic on this one. And lastly, you got Tipranks here. So Tipranks is going to say that it is 24% upside. There are 3 buys on it, strong buy. $73 a share right now, 84 low, 91. I think that's average. So it looks okay. You're really betting on the future of how Ackman's going to do. I think he'll do okay. My just point of contention is I don't like that management fee. I think that's unfair for shareholders. But I just want to let everyone know about this company and to see where it's going, and I'll cover it in the future. All right, thank you, everyone.